Start this off. So thank you, Darcell, for coming. If everybody doesn't know, he is our accountant. He's a friend of mine. He handles everybody's payroll, and then if you do need anybody for a tax return, he is your man.
Appreciate the business if you need any help.
So anybody?
So it was my understanding you guys had some questions regarding, payroll and then some of the numbers that you guys have been seeing last few weeks, I guess, last couple of months. So this is what I'm here for.
Well, personally, I want to know how can we keep more of our money in our pocket and not pay as much on taxes? Is that possible? If so, how would you?
There are some things that that you could do with you being a W-2 individual. Somewhat it is pretty straightforward, and I'll get into two things that you could possibly do. All right. First thing is pretty much just maybe estimate what you plan on making for the current year. So this is what I like to do when people I offer this. Not everybody accepts it, but I sort of like to start off from current year. Last year is already gone. There's nothing we can do about that. So as soon as December 3rd or January 1st gets here, that year is closed off. So there's really nothing you can do somewhat to a certain extent. So what I like to do is start off with, hey, how much do you plan on earning this year? And I get the figure, and what I can do is I can give you a tax estimate at that point and say, hey, look, if your working wages are this is what your tax will be. If you don't live in a house, if you're not going to school, if you don't have any dependents, this is what your tax liability will be based on the numbers that you just gave me. And from there, that's your roadmap. So if you tell me, hey, I plan on earning $60,000 this year, I'll tell you, all right, based off $60,000, if you file single, you're not going to school, you don't pay any student loans, you don't have a house, you don't claim any dependents. This is what your tax liability would be by the end of December 31st. Now it's up to you to get there. Yeah. And with you guys having Gusto now, you guys have the tools in your hand, or you've always had the tools. You would have to call me and tell me, hey, I need to update my W-4 or my G-4. But now you guys have those tools in your hands. You guys can actually go into Gusto and update your withholdings and things like that, okay? So that's one way that you can sort of take away the anxiety or maybe do some tax planning for the future year. That's just a basic way. The second thing is through home ownership. If you do own a home, you could possibly itemize, and that could be a way for you to get some tax savings. Through itemizing, you would claim that your mortgage interest, your donations, your car taxes if you pay those. Those are some of the big things. You may hear about claiming medical expenses. That's true to a certain extent, but it isn't cut and dry like that, meaning that, hey, I paid $300 in going to the doctor. Most people think they can deduct that, but it typically doesn't work like that. But it's always best to go ahead and give that information to who's ever doing your taxes, or if you're doing them on your own, entering it yourself.
And is that because there's a standard deduction as far as if you're going to do an itemization, don't you have to compare that to, don't we all get a standard deduction anyway?
Correct. And with the standard deduction being raised so high, because right now it's almost like if you're single, it's almost at $13,000. And what Brian's talking about is standard deduction is something that the IRS already gives you, and it's a subtraction off of your income. Okay, so if you were to make $60,000 and you get a standard deduction of, let's just say $13,000, well, you're going to be taxed on $47,000. So basically, it just knocks off some of your income, so you're not paying tax on the whole 60. All right. So your itemized deductions need to be over $60,000. So your mortgage interest, your house taxes, your land taxes, your donations, all that stuff needs to be over $13,000 before you can itemize. Okay. So a lot of people get caught up in that. And I know it's somewhat tax jargon, but all I can say is just enter the information, just bring it. If you don't think it's going to work, don't never not bring it. Just bring it, let somebody take a look at it, or if you're doing your own taxes, just throw it in there, because sometimes the tax rules change every year, okay? Another thing that you can do is you could put money in your own retirement, right? So that could be a deduction that you could possibly take. You could open up a traditional IRA, okay? And what that is, a traditional IRA, it'll somewhat give you a deduction on your tax return, and then you'll also be putting money in your own retirement for future years, okay? I want to say the most you can put in it this year is like $6,000. So let's say you put in the full amount of $6,000 and you're able to claim that deduction. Well, what that does is, once again, it knocks down your income, right? It subtracts off your income, which is a good thing. So in the example I just gave you, remember how I told you you're gonna pay taxes on $47,000? Well, you put that $6,000 in there. Well, now you're gonna pay tax on $41,000. All right. Now that doesn't mean, when I'm throwing these numbers out there, it's not meaning that you putting $13,000 and $6,000 in your pocket. It don't work like that. All right. What it does is it reduces your taxes based on based on whatever your tax bracket is. Okay. So just to keep everything simple, let's just say you earn that $6,000, you get that $13,000 deduction, right? You knock down your income to $47,000.
Right.
Let's just say you're in the 10% tax bracket. You're gonna pay taxes on $4,700. Okay? So basically what I'm doing is I'm taking your income, that $47,000, I'm saying you're in the 10% tax bracket. So you take $47,000, multiply by 10%, you're now paying taxes on $4,700. That's
but aren't you, isn't it a progressive, isn't it like the first X amount you're paying
Correct.
this amount of percentage, then, so it's not exactly,
It isn't that cut and dry, no.
Would you explain, because I don't think most people in general don't understand that. Can you,
Okay.
You got
Yeah.
a whiteboard if you want to use it. I like them. It's up to you.
Well, what Brian's talking about is, it's progressive in that as you earn more money, you're being taxed at a different rate. So once again, don't use these as true numbers. I'm just trying to provide you with an example, okay? So let's just say you're filing single. Let's just say your first $10,000. The IRS says your tax bracket is 0. You're paying 0 tax on the first $10,000. Let's just say from $10,001 to $15,000, you're paying 3% on that. All right? Your $15,001 to $25,000, now you're paying 10% on that. So you're not paying a true, when I'm saying 10%, you're not paying a true 10% on all your money.
Right.
It's as it goes up to different levels, you're paying taxes on that income tax bracket, right?
Right.
So what the tax bracket actually is, it isn't actually like cut and dry 10%, 15%, 20%. You're going into different brackets, right? And your cumulative or your total tax may be the average of all of that. So your true tax, let's say if you make $100,000, right? If you look at the tax tables, it may say for filing single at $100,000, you may be in the 18% tax bracket. But when you add up your cumulative tax bracket, your total tax may be 13% off of $100,000. Okay, so you're not paying 18% on all that $100,000. Okay, now I know that's getting a little bit more complex, but that's what he means by as far as like a progressive tax bracket. All your money's not taxed at a flat rate.
Right.
Okay.
So, for instance, like if you make $60,000, I think that's probably it's $50,000 or $60,000. But this one's example is 60. You'll be taxed $9,218 if you live in Georgia. That's total. That's federal and state. Your average tax rate is 10.3%. Your marginal rate is 22, but it's only for the last portion up to 60,000. Is that right?
Somewhat like that. Now, when you say Georgia, are you looking at the Georgia tax table or are you looking at federal?
Oh, that's just the Georgia.
Oh, okay. Yeah. Now Georgia is a little bit different than federal. Federal is definitely progressive. Yeah, it's definitely, like I was telling you. You know.
I know that was that was Forbes. That was if you live in Georgia, but it's all of your taxes in general. I guess state is just a set percentage.
Correct. Yeah.
That was doing the federal and the
Georgia.
yeah, because here.
Okay. Yeah, Georgia pretty much is like a 6% tax bracket for the most part.
Yeah. There you go. You can pass that around if they wanted to see it.
Okay.
If that's accurate.
Yeah. So what you're talking about is, this is the federal side here, and this is the state.
Okay, and that was the marginal tax. That's like the highest part of their bracket, and then all the progressive increments averages
Out to 10.31%.
Does anybody understand that?
Not all the way. It's a
Okay.
little fuzzy.
So what I like to do is I like to just basically what I'm talking about is when I said you're gonna be at $60,000,
Right.
what I was talking about is that's what I believe your average tax bracket is gonna be 10%.
Okay, so you would just subtract 10%, 10.3% from that 60.
You would not subtract, but you would multiply that by your $60,000, and then that's sort of gonna give you a rough idea of how much you're gonna pay in taxes. So once again, to the $60,000 example that I'm giving you, the IRS is gonna give you like a $13,000 deduction, right? So you're not gonna be taxed on the whole 60.
Right.
You're actually gonna be taxed on, once you subtract your standard deduction, which is $13,000, close to it, you're gonna be taxed on that 47,000. So you take that 47,000, you multiply that times 10% roughly, and what I would tell you is, hey man, you need to get to $4,700. That's what you need to have withheld by December 31st in order to break even with the IRS. Now that's not gonna get you a refund.
Right.
That's gonna make you break even with them.
Right.
So when you do your taxes, you look at your last paycheck stub. If you're at 4,700, you remember what Darcell said? Darcell said I should be at 4,700. You do your taxes, and you're not getting nothing back. You know, because you hit that, right?
Yeah.
And then if your withholdings by December 31st is like at $6,000, well then you know you should be getting back $1,300. See what I'm saying? So it's really broken out like that. And I'm trying to take the fear out of taxes or hey, how does this stuff really work? All you got to really realize is that if you guys are single, take your number, your 60 or whatever your income is gonna be. Subtract $13,000 off of it. Whatever that number is, you just multiply that by 10%. That's the number you got to be at by December 31st.
So how do you know if you get the standard deduction? What?
That's pretty much given to everybody.
Okay.
Yeah, that's not something that you got to work for. You got to know, if you do your own taxes, it's automatically going to put it in there. All right. And then most software, if you go to the itemized section, that's where I was talking about entering your home stuff, donations. Remember I was telling you how that number needs to be over 13,000?
Yeah.
Well, once you go into there and you start messing around, you start plugging figures, like if you do own a home, most software is not going to give you the lower of the two. They're going to, if your itemized deductions are lower than your standard, they're going to give you the standard anyway. So you don't have to be worried about, hey, I just messed something up, because I'm looking at my itemized stuff and it's only $200. Well, most software is going to give you the higher of the two. Okay, so that sort of takes the fear out of that. Most software is pretty good about that, But if you're looking for another deduction, I would say, hey man, put money towards your retirement. That's a great way. That's a great way to give yourself a deduction.
That way it goes into your future pocket, but it also decreases your tax liability.
Correct.
Like the IRA you were talking about?
The traditional IRA that I was talking about.
So what if you did have, what if you did get one of those IRAs? Would you still fall under standard deduction, or would you have to itemize?
No, that would be in addition to your standard deduction. Remember how I told you, everybody's gonna get standard deduction, period.
Yeah, so you could theoretically, if you maxed it out, you get your 13,000, and then if you max it out for $6,000 for an IRA, you could pay down basically $19,000 of your. So if you did $50,000, you'd be taxed at $31,000.
Yeah.
If you did that.
Subtract from the IRA.
Correct, because you would get a subtraction. You'll get an additional subtraction in addition to your $13,000 that you're already getting. So just think about it like that.
But now you are, as far as money in your pocket throughout the year, you're talking 31,000, and then if you deducted $3,000 from that, you're at 28,000. You divide that by 12 months. Your bring home is only going to be a little over 2,000, like it'd be 2,500. No, it's not even 2,500. It's like $2,400 a month. So, like, everybody, myself included, has been down the rabbit hole of I want to hold on to all my money. And like, okay, well, what kind of tax incentives, what kind of things can I do to not pay the taxes? And every single time, yes, that future money, as far as it's a great way because you're planning for your future. It's compounding. It's excellent. Everybody should do it. The IRA, but it's taken away from your dollars in your pocket. You're not paying the tax man quite. I'll tell you how much you're saving. Okay, you're saving $600 on taxes.
Correct. And
but you're spending $6,000.
I was about to get into that.
But it's going into your pocket 20 years from now, 30 years from now. How old are you?
30.
35 years from now. It will go into your pocket, compounded, multiplied by 3 times. Yeah, but if you don't do it, you got nothing. Unless you plan for something. Unless you're old, broke down, you ain't got no money.
Yeah, Connor's 18, so yours would be a lot different story.
You could, if you retired at 65 and you maxed out your IRA, you'd have about $3 million.
And all this to be said, sounds like being a W-2 employee forever doesn't sound that great. I need to make some plans to get out of that if possible.
Right.
So this is sort of what Brian was talking about, and this is the income example here. That's the standard deduction. That's your taxable income, right? So remember how I told you if you stop here, that's going to be your taxable income. Your tax on that is going to be $4,700, basically 10%. Okay. So this is what your original tax was. 4,700. Okay. You do that IRA, it's going to drop your income down to 4,100. So now your tax is 4,100, still 10%, right?
Right.
So if you look at it, if you put $6,000 in it, you're only getting a $600 deduction. I mean, $600 tax savings. Because you might as well say any deduction that you get is saving you 10%. All right. So let's say if you were able to itemize, and your itemized deductions were $20,000, right? So you got 60 minus 20, that's $40,000. So even with a $20,000 itemized deduction, you only saving $700. You only saving $700. So you spending 20, but you saving just $700.
Yeah.
You see what I'm saying?
Yeah.
So that's the difference, between a deduction and a credit. And I'll get to credits in just a second. But a deduction, when people are talking about deductions, it's only saving you, just keep in mind 10%, okay? I'm not saying everybody's tax rate is 10%, but for the most part, what I see is people are normally somewhere around 10%. For every dollar you saving, for every dollar you spend, you're saving 10 cents. That's what you think. That's what it equates to. Every $10 or every $100, you're saving $10.
Yeah.
That's all it is. So now you guys were sort of getting off into, well, what's the point? I'm spending $6,000, I'm just saving $600. That's a lot of damn money, right?
Yeah.
That's a lot just to save $600, right?
Correct.
So, but the other side of the coin is this, like he was saying. Now you're putting money towards future years, right?
Yeah.
That could, these $6,000 could add up if you continue doing it over a number of years, okay? it was one of the things that unfortunately I had to utilize when I left my W-2 job and I opened up my own business. It helped me start my business. Without it, I wouldn't have been able to do it, you know. We all live life. We pretty much spend our paycheck, you get $2,500. I'm pretty sure about a week you done spent your $2,500 and you're looking for your next $2,500, right? Everybody lives that way. But what I was doing, it sort of was one of those things. Hey, you put it away a little bit at a time. You don't see it come out of your paycheck, and then boom, now you done amassed a lot of money, you know. So it's just one of those things to think about. You do have to look at your future plans going forward, because one day we're gonna want to retire. Our bodies break down, right? So you're gonna want to start putting money away at some point. All right.
Yeah.
So you were asking me about things that you could do to save. With you guys, with you being on a W-2, that'll be one of the ways that you can instantly give yourself a tax savings. But you got to remember, you know, even if you did max it out, you're really just bringing your tax liability down by 10%. Okay.
Yeah.
So just keep that in mind. Now,
Well, what if you don't max it out? Would that like vary your deduction?
yes,
from it?
it would vary your tax savings. It would.
Yeah, so if you did, if you did 3,000 for the year, you'd have a $3,000 deduction. You'd save $300 in taxes.
Yeah. So whatever you
don't
put
have
into
to.
it,
Yeah, do something. $100. Because shoot, it'll double. Your investment will double 3 times in 30 years. Every 10 years it doubles, compounding.
Okay.
all right. But the main thing to think about, man, is I understand nobody wants to pay taxes. I get it. Nobody does, but we got to. You know, I mean, hell, the way they got this thing figured out. You know, yeah, you can put a bunch of nonsense on your taxes, and that's a way to give yourself a tax deduction. But you know, you get that letter, they gonna start digging. You see what I'm saying? Then the gig is up. You know, so.
Did you want to hear the escort thing,
Yeah.
McKee?
Yeah.
So McKee,
That letter.
McKee knows some of these other guys may have heard, but not understand why. Why would we create an escort?
Okay. Let's look at this example here, and let's not think about it as W-2 income. Let's think about it as business income. Okay.
Or profit, right?
Yeah. But just from a business standpoint.
Right.
All right. So you guys are now all self-employed. All right. Let's just do this. All right. We're gonna change some of these things up. All right. So let's just say we're gonna use this number. This is your gross, meaning that this is everything you've billed and everything you've made for the year. All right, as a self-employed person. This right here, let's just call this expenses. All right, let's call this net profit.
Hey, Darcell.
Mm-hmm.
Apologize for interrupting. Would there be a way to use an applicable example for what like relative to our numbers?
We could. Let's say we build, I'm just gonna use round off numbers.
Yeah.
Okay? Let's just
That's
say we
close enough.
build $1 million, right? We made $1 million, but our expenses were $900,000. Okay, that's payroll, that's rent, utilities, gas, all that stuff that y'all do every day, equipment. And let's just say the net profit or the final number is $100,000. All right. Now, if we did, I'm gonna go over if we didn't, and then if we are an S corp. Okay. If we're not an S corp, I'm just gonna say off of this $100,000 right here, you owe the IRS. We're just looking at IRS. 25% of that. So that means you got a tax bill of $25,000. That's what your tax is. if you're self-employed or you're a single member LLC or even a partnership. A partnership fits along these same lines too. Everybody's gonna fall into the same tax structure. So you don't, when I talk about standard deduction and all that kind of stuff, that doesn't apply here, okay? So this is what your tax is if you're just the everyday Joe, all right? So what this means is a quarter of your money is going towards taxes.
A quarter of your final profit.
Yes, is going towards taxes. That's a lot. That's a lot. So now,
And you gotta pay self-employment tax.
You just spent 12 months.
Yes.
You know, you just spent 12 hard months to get that, and you're giving a fourth
actually,
away.
you bring up a good point. I didn't even think about that. The 25% is roughly your self-employment tax, right?
Yeah.
But you also remember the 10% I was telling you about? Because see, when you're self-employed, you got self-employment tax and you got regular income tax. So you actually pay two taxes if you're self-employed, and everybody pays that. Actually, once you throw in that 10%, this is truly what your tax bill is: $35,000, somewhere around there.
Yeah.
That's what your tax bill
Then
is.
Georgia will tax you.
And then Georgia's gonna throw another 6% on this. So after you put the state on it, you done paid 41%. Damn, 40% is going towards taxes. 40. So you actually are putting in your pocket only 60%.
And that was, so we just went from an LLC to an S corp retroactively for 2022. So we got taxed as an S corp for 2022, but all before that, we were an LLC and it didn't much matter because we didn't profit. To another thing.
So you might as well say your number is 40%.
Right.
Okay? Now, let's do the S corp thing. The reason why this is important is because now you get to determine how much of your money goes towards that type of tax and how much of it goes towards dividends. So you actually get to pick how you want to break this income up. Okay? The IRS doesn't give you any direction. And of course, remember the 35%? You're not getting away from it. But what you're doing is you're not allocating all of this towards that 35% or that 40%. Okay? Once you put the state on it. So what you get to do is, and they don't give you any direction, but you gotta use some common sense. You can't say, well, hey, I just wanna pay 10 grand and the other 90, I'm gonna pay myself in dividends. That's not gonna fly. You're gonna get audited. So you may wanna do a breakout like this. Let's just keep it equitable and let's just say 50%. So now I wanna take 50 and I'm gonna pay my 35% in that. Or 40, sorry, 40. Once you put the state on it. For this other 50, I'm gonna do that as dividends. And let's just keep it easy. Keep it easy so everybody can follow. With this other 50, I'll select that as dividends. If I don't have any other income, what I may do is that 50, let's just say I'm gonna pay 10% of tax on it. It could be 0. Let's just say it's 10%. That's $5 grand. Over here, what we got here? 10, 20? Yeah. We got 20. Our tax bill is 20 here. Our tax bill may be 5 here. So we done went from $40,000 in tax. I should have put, yeah, that's right. 40 grand in tax to now 25. All just by changing your tax structure. So you saved 15 grand instead of paying all that tax. Now this number right here, because dividends can go between 0 to 20%. It just depends on how much other income you have. Okay? This is once again just an example. This could be 0. This could be 0. And let's say if it is 0. So now you've saved 20 grand total just by changing your tax structure.
So how do you know what the percentage will be on the dividends?
Like I said, once you once you compile all your other income, it'll pretty much spit it out for you. Dividends are taxed at a lower rate than W-2 income as well as self-employment income. It's taxed at a lower rate. That's why when you see these millionaires and everything, or people that are doing well, they don't really take a paycheck. They pay themselves through stocks, property that they own, because all that stuff is taxed at capital gains rate, which is lower than this stuff right over here. So that's what, if you can convert your income from this to this, you'll have a greater tax savings.
And the reason, correct me if I'm wrong, the theory on it is America wants businesses to be built. Small businesses built is what America is. And so you're incentivized to grow a successful business, to have profits, so that you can structure as an S corp, because America wants that.
Yeah.
And if the tax code, instead of like any game, doesn't matter what it is, there could be hide and seek games, little rules in there that you don't like, but if you're playing the game, it is very important to understand the rules and then figure out, okay, what are they trying to do here? Mm-hmm. Why do they have this? Like, why do you think real estate has so many tax incentives? It's because America was built on the American dream of home ownership, yeah, but buying homes, buying commercial properties helps America, because they don't want to have vacant buildings, and also helps your county and your state if you build and create new real estate or create jobs, because that's what government, that's what their purpose is to grow the people in the industry. And that's if they're going to promote something, it's going to benefit them in some way. It also benefits us. If you grow a business, just look at this business, and it's a very small business, but at $1 million, we've got 12 people that have jobs, that have good paying jobs, and those statistics help politicians get elected. Like if you got a high or a low unemployment rate, if you're creating jobs, they do want to they want to incentivize you to do that, and is that the basis of it as the why?
Yep.
And then debt, as far as like, I think what's in the news a lot is these stock things, like for instance, Elon Musk or whatever, his tax bill is monstrous on other things, but like he borrows from his stock. Mm-hmm. And like if you've got damn near $1 trillion in net worth and you borrow at a rate that's lower than what you can return yourself from your own work, then that's him playing by the rules of the game, because you don't get taxed on debt. He's got to pay it back somehow, but he just pays it back. And from what I'm looking at, his stock keeps going up. Mm-hmm. So all he's got to do is, as the stock goes up, give that back, and he's good.
That's how he takes his money out, and not paying any tax on it.
And I think it gets a bad rap. Like, all these rich people don't pay taxes. Yes, they do. They pay a lot of damn taxes. And
well, the number looks big, but you got to look at it percentage wise.
Yes.
Percentage wise, that's what you got to look at. So, when you start looking at those percentages, damn near 40%, federal and state, that's pretty damn high.
That's super high.
And then conversely, when you're looking at them, yeah, they pay millions of dollars, but when you look at percentage, their percentage may be 20%.
Yeah. So it's half your percentage, yeah.
Yeah. So
half our percentage. But I think also, like, would you say, as far as W-2 income, like you own real estate, right? Mm-hmm. That helps you out.
Yeah.
Building wealth, building income, but also tax liability wise.
It does. Well, the type of real estate I have is like rental properties, and when I go out and buy those rental properties and fix them, then sometimes that creates a loss for me, a paper loss for me, right? So that reduces my other income. So, you may see those losses on my tax return, but some of that might be depreciation, and that's another thing too that we talked about, equipment, right? The reason why you want to wait until towards the end of the year, like let's say you got this $100,000, right? And I think you guys have brought this up at one point. And I just want to cover this before y'all got to bounce. But
Cool.
if you know you have equipment purchases, you're gonna be purchasing some equipment in January or February or March, why would you hold on to this? It makes no sense. You spend the money because it's an expense that has to be made anyway,
Yeah.
right? So all that comes through planning and talking and things like that to say, hey, all right, Brian, hey, y'all got any equipment that you got? Yeah, matter of fact, yeah, man, I got to get a new mower or whatever. Cool. Well, instead of saving this, paying the 40% on this, right? And you know, it's gonna leave you with $60,000 left, and then you go out there and you go buy equipment for $10,000. Now you're at 50, right?
Mm-hmm.
You take your 100, you spend the 10, right? You spend the 10. Now you're only taxed on 90%, on 90,000 versus the 100, right? So you do your 40%. 36. That's 36. So 36 from that. Forgive me, guys. For some reason my brain ain't working.
54.
54. 54,000, right?
Mm-hmm.
So that right there is your net amount versus this. So you got more money to operate with. That's why you spend the money before you pay taxes on it.
But that's if you're a W-2 worker or a single employee.
That's self-employed.
Self-employed.
Yes.
Yeah, that's the business example.
Yeah, that's the business example.
So if it was an how does it say?
S corp.
S corp. So if it was an S corp and you were to break it down, like you said, 50 and 50, would you still spend the money that you're getting taxed on from the 40, or would you spend it from your dividends?
It'd have to be from the dividends because you already took the 50 from a W-2, or you could decrease you could play with it, right? Like if you wanted to.
In this example here, are you talking about like spending the money on the equipment? Is that what you're talking about?
Yeah.
Okay. So it would still hold true. This example would still hold true. It's just that maybe at 90 grand, maybe you don't do a 50-50 split.
Yeah.
Maybe you do a 40 on this side and a 60 on the dividend side. But either way, you're still gonna save money, right?
Okay.
It's just that the IRS doesn't, when you start getting into the larger numbers, I would say try to be a little bit more equitable, right? If this number was like 10 grand, if the final number was like 10 grand, and we're talking about doing the dividend split, hell, I'd probably put it all in 10. Because that's no money. I mean, what they gonna, I can't say what they would do, but why, I don't believe they would chase after you because they're gonna get very little revenue off of that. You see what I'm saying? But 100 grand, I wouldn't do 90 here and 10 here. Yeah, because you looking for an audit. You know, at that point, then they're gonna hit you with penalties and fines and all that kind of stupid stuff. So, but that's a good question though. But that's why you expense before you go into the new year.
Okay.
That's why you look at trying to, hey man, you know, we got, as long as you got the cash or you got the financing to do it, then that's the time frame to do it.
Yeah.
Okay.
And then there's still like, even with us, like this is our profit year.
Mm-hmm.
You know, it's our profit year, yes, but we're adding 2 locations for 2024, right? So we got the $150,000 goal for adding cash to our bank account December 31st. But we also know we are going to open up 2 locations for 2024. So all the bonuses and stuff, like the field team, we'll see the 150 and we'll do the bonuses on that. So the field team, you know, will for that 4th quarter, because for the field team it only applies at that per quarter. We're not gonna, you know, remember how I took out all purchases, although they were made for 2022, but if they were for growth, like for the franchise fee for North Augusta, I took it out of the P&L so that y'all would get fair amount of bonus dollars. We'll do the same thing whenever at the end of this year. So we'll end up needing to purchase 4 trucks. And 4 mowers and all that. And so we're gonna spend at least $80,000 per location, and we're gonna get debt on half of that. So we're gonna put up $80,000 in cash, and we're gonna get debt on $80,000 of that. So whatever we can expense, the 2 franchise fees, which at that time they'll be $20,000 a piece, that'd be $40,000. And then the 4 trucks, let's say we get them for $8,000 a piece, that's $32,000. 4 mowers, that's $20,000. Like it will cut down that what we're gonna pay on the profit. But that, like he was saying, if you've got the end of the year expenses, that's you only do it if you're growing. I mean, you can do, like, for instance, I could, if we didn't have all these growth goals and I just wanted a nice new truck, I could buy a $100,000 truck.
That's right.
But that's just not how we operate. And that, what I would say, is unwise in general anyways. It's just a truck. But yeah, we'll be.
You got the choice of either doing personal stuff, but anytime you do, you take those profits and you spend it on personal stuff, you're gonna pay the tax on it. So
it's best to keep it back in the business.
Yeah, as much as you can. I mean, at some point he's gonna want to pull money out. You know what I mean?
Yeah.
He's the owner. I mean, it makes sense. You want to have nice things too. But hey, you guys are in high growth mode. He's taking the money and putting it back into the business. And hopefully those dollars will turn around and make other dollars for him.
Yep.
Perfect.
Yep. So, in short, from learning about what W-2 income is and what you can do as far as your wealth with, if you are, an S corp or something